Okay, let's unpack this. We've got this really fascinating situation on our hands, where it's something that, well, it feels like a paradox.
Hmm.
You have a company, they just reported absolutely stellar financial results, record-breaking revenue, crushed expectations, top and bottom line, raised guidance,
Yeah.
and the stock goes down. What on earth is going on here?
What's fascinating here is exactly that disconnect. It seems counterintuitive, doesn't it?
Yeah.
Especially when you look at the actual numbers the sources lay out.
It absolutely does, and that's really the heart of this deep dive. We're zeroing in on Adobe, ADBE, a company most people know, obviously, for their creative tools, but we're looking at it through the lens of the sources you've shared.
Right.
Our mission really is to dissect these Q2 results, try to figure out why the market reacted with, well, skepticism despite what looks like amazing performance, and explore these competing narratives around AI, competition, valuation, strictly based only on what's in this material.
And that source gives us a very detailed look. It argues pretty strongly, actually, that this market reaction isn't really a sign of poor performance from Adobe itself.
Okay.
It's more like a fundamental shift in what the market is demanding right now from, leading tech companies.
Exactly. It presents this paradox right up front. So, okay, let's dive into the details of that Q2 performance. Stepping through the sources, what were those headline numbers that looked so good? How did they stack up against expectations?
Well, the pure strength of the quarter was undeniable. Adobe reported record revenue, $5.873 billion.
Wow.
That's an impressive 11% increase compared to the same time last year. And it comfortably beat the consensus estimate, which was sitting around $5.8 billion.
Okay, so a solid revenue beat. What about the bottom line, profitability?
It's just as impressive, maybe even more so.
Mhm.
On the profit side, their non-GAAP diluted EPS, earnings per share, was $5.06.
Okay.
That's up a strong 13% year over year, and it significantly exceeded the consensus forecast, which was about $4.97.
Right.
Even their GAAP EPS was solid at $3.94. The source really points out this isn't just hitting targets. It shows, exceptional operational execution, highlights the resilience, the power of their business model.
So, undeniably strong core numbers. Where did this strength come from? How did the different parts of their business contribute?
Yeah, the sources highlight the two core segments driving this. Digital media, that's the biggest one, right? Photoshop, Acrobat, all that.
Mm-hmm.
It grew 11% year over year to $4.35 billion. And a key metric, annualized recurring revenue, ARR.
Right, the subscription health measure.
Exactly. Within digital media, it hit $18.09 billion. That's up a robust 12.1% year over year.
Yeah.
It really underscores how incredibly sticky, how valuable those core platforms remain.
And within that huge digital media segment, did the sources break down like the creative side versus the document side?
Yeah, they did. The creative and marketing professionals groupthink Photoshop, Premiere Pro users,
Yeah.
the heavy hitters that saw strong growth, up 10% to $4.02 billion. So that indicates their core professional user base, the heartland of Adobe's business. They're staying loyal. They're continuing to spend.
Good sign.
And Document Cloud also showed significant vitality. Engagement metrics like Acrobat Link, sharing monthly active users, grew more than 20% year over year.
Done.
So expanding use of their PDF tools too.
What about their other main segment, digital experience? That's more the enterprise focus side, isn't it?
Exactly. That segment also showed steady growth. It was up 10% year over year to $1.46 billion. Subscriptions within digital experience rose 11% to $1.33 billion.
Okay.
And the source notes that while it's smaller, this segment is strategically vital. It reinforces Adobe's position as this end-to-end platform for enterprise content, from creation to delivery, personalization, analytics, the whole workflow.
Right. Beyond the top line growth and the segments, the sources really hammer home the incredible profitability and the cash flow this business generates.
Absolutely. The source calls it a financial fortress, and honestly, the numbers back that up. Gross margins are truly elite, like around 89%.
89%.
Yeah, amazing. Non-GAAP operating income was a robust $2.67 billion just in the quarter. This subscription SaaS model, it just generates powerful cash. They got $2.19 billion in cash flows from operations. That translates to a free cash flow margin of 37%.
Wow.
And that kind of financial strength is crucial, right? That lets them invest heavily in R&D, maybe do acquisitions, return capital to shareholders. They bought back about 8.6 million shares during the quarter.
And they didn't just report a strong quarter, they actually raised their guidance for Q3 and the full year.
Yes, exactly. They raised their outlook for both Q3 and the full fiscal year 2025.
Mm.
For Q3, they projected revenue between $5.875 billion and $5.925 billion. Non-GAAP EPS between $5.15 and $5.20.
And how did that compare?
Well, the midpoints of both those ranges are already above what analysts were expecting before they even saw these great Q2 results.
Okay.
And for the full year, FY25, they boosted the revenue outlook to $23.5 billion to $23.6 billion, and non-GAAP EPS up to $20.50 to $20.70.
The sources point out something interesting about that raise, though, that it might be, well, more significant than it looks at first glance.
This is a key nuance, yeah.
Yeah.
Analysts, like those cited from Jefferies, they noted that the upcoming 7% price increase for Creative Cloud,
Right, that's coming soon.
yeah, effective June 17th, that was likely already baked into Adobe's original guidance for the year.
Ah, okay.
So the fact that they still raised guidance after this strong Q2 beat, it suggests the outperformance is being driven by factors beyond just that known price hike.
Like what?
Like genuinely better than expected organic growth, maybe stronger customer retention, or perhaps, and this is key, earlier than anticipated success in actually monetizing their AI features.
Interesting.
The source implies this could actually make the updated guidance potentially conservative, suggesting the business is tracking ahead of even their own internal schedule.
Okay, so let me get this straight. By pretty much every traditional measure, beating revenue, beating EPS, raising guidance, strength across segments, elite financials, massive cash generation, it looks like an almost perfect quarter.
Pretty much, yeah.
So circling back to that paradox we started with, what does this all mean? Why the market skepticism? Why didn't the stock jump on what seems like fantastic news?
Here's where it gets really interesting, and the sources spend a lot of time on this. As the report notes, despite all that undeniably positive news, the stock actually retreated after hours.
Right.
The market simply wasn't as impressed as those headline numbers might suggest.
Why the cold shoulder then? What is the market demanding that Adobe, even with these results, didn't quite deliver on in their eyes?
The source argues this reflects a pretty significant recalibration in market expectations for all leading tech companies right now, actually.
Yeah.
Investors today, they aren't just rewarding steady incremental beats or, reliable double-digit growth anymore. They are demanding transformative exponential growth.
Yeah.
And critically, they want it to be unambiguously fueled by generative AI.
Right, the Gen AI hype.
Exactly. The source uses phrases like AI fatigue. Investors have heard a lot about AI potential, but maybe haven't seen massive, clear revenue impacts yet. And it points to sky-high, perhaps even unrealistic expectations. The market, in this view, is kind of holding out for a true breakout moment in AI-driven revenue that they just haven't fully seen or believed in from Adobe yet.
Okay, so the market wants hard financial proof. They want AI to be adding explosive growth, not just incremental stuff. What's Adobe's strategy for delivering that, according to the source material?
Well, the central pillar of the bull case presented in the source is Adobe's pretty aggressive, multifaceted strategy to integrate and, crucially, monetize generative AI, specifically their Firefly family of models.
Firefly, right.
The narrative here seems to be shifting from viewing AI as just, a cool feature within existing products, to seeing it as a distinct and powerful revenue driver in its own right.
What are the signs that Firefly is actually gaining traction with users? Because, adoption is key before you can really monetize it, right?
Absolutely. And the source provides some pretty compelling adoption numbers.
Yeah.
By early 2024, users had created over 16 billion assets using Firefly-powered tools across Adobe's ecosystem.
16 billion.
Yeah. And as of March 2024, a remarkable 45% of all Creative Cloud subscribers had engaged with Firefly in some way.
Wow, almost half.
Usage of generative AI features within Adobe Express, their more consumer-focused platform, it tripled. Traffic to the standalone Firefly app surged by 30% sequentially, and paid subscriptions for that specific app reportedly doubled.
Okay, that sounds like real momentum.
And critically for the enterprise story, Firefly is installed in design teams at a staggering 72% of Fortune 500 companies.
72%.
Yeah. So this isn't just casual tinkering. This indicates real utility, real adoption, and it helps create that sticky flywheel effect the source talks about.
Those are definitely impressive adoption numbers, but how are they actually converting this engagement into dollars? How is Adobe monetizing AI today?
The source details 3 specific levers for AI monetization. The first is direct revenue.
Okay.
In the first quarter, They reported over $125 million in AI-driven AR annualized recurring revenue, specifically from standalone products like that Firefly app and add-ons like the Acrobat AI assistant.
Right.
And management is confident this figure will double by the end of fiscal 2025,
Yeah.
reaching over $250 million in AI-specific ARR.
Doubling. Okay.
A key mechanism here is the new credit-based system for generative AI usage. The source highlights that nearly half of users who use up their initial free credits, they're actually purchasing more.
Ah, that's tangible proof. People are willing to pay.
Exactly. It's quantitative proof that users see value and are willing to pay for extended use. That's pretty significant.
That willingness to pay for credits does sound important. What are the other levers?
The second is pricing power. That upcoming 7% Creative Cloud price increase we mentioned.
Mm-hmm.
It's explicitly called out as a strategic move to capture the value that this AI innovation adds to the core products.
Mm-hmm.
Embedding powerful, time-saving AI features makes the software more valuable, right?
Makes sense.
And Adobe feels this justifies a higher price point. The source, citing Jeffrey's analysis, notes this hike also helps protect those elite gross margins we talked about.
Right, the 89%.
And funds further R&D into future AI capabilities. The third lever is ecosystem stickiness.
Okay.
By embedding Firefly capabilities directly into the core indispensable apps like Photoshop, Illustrator, Premiere Pro, Adobe makes their entire platform even more essential.
Harder to leave.
Exactly. It increases switching costs for users who rely on these integrated workflows. Features like the AI assisted in Acrobat are described as a game changer for productivity within the document workflow. Makes the whole ecosystem stickier.
So it's not just one big, splashy AI product. It's weaving it in everywhere and finding multiple ways to actually charge for it.
Precisely. It's kind of like a land and expand strategy, but applied to features within their huge existing customer base.
Okay.
The initial free generative credits land the tech widely, get millions of users trying it at no extra cost. Then the metered pay-as-you-go credit system expands the revenue by monetizing those power users who really need it.
Right.
The source views this as a strategic, maybe lower-risk approach compared to, say, launching a completely separate, expensive AI product tier right out of the gate.
And their long-term AI vision, the source mentioned something about commercial safety. What's that about?
Yeah, that's a crucial element, especially for their big enterprise clients.
Yeah.
The focus is on developing commercially safe AI. Meaning by training Firefly mainly on licensed content, like their massive Adobe stock library, they could offer indemnification against copyright risks.
Protection from lawsuits.
Exactly. That's a critical differentiator for large corporations worried about legal exposure from AI-generated content. Looking further out, management talks about a vision for an agentic AI platform.
Okay.
That could basically orchestrate complex creative and marketing tasks automatically across workflows, positioning Adobe as a strategic partner in automating digital experiences.
So the AI story the source presents is definitely compelling. Clear adoption, multiple monetization strategies. But as we know, the market wasn't fully convinced yet. What are the risks and competitive pressures the sources highlight? What's potentially holding the stock back?
Well, the most prominent competitive threat discussed pretty extensively in the sources is Canva.
Canva, right? Comes up a lot.
Yeah. Canva's gained huge popularity focusing on ease of use, templates, accessibility, especially targeting non-designers, marketers, small businesses, even individuals. And the source points out the stark pricing difference. Canva Pro is around $14.99 a month per user. Adobe's Creative Cloud All Apps subscription, closer to $59.99 a month. Big difference.
Even though, as we know, Adobe's Pro Tools, Photoshop, Illustrator, they're technically way more powerful for deep, complex work.
Yes, precisely. The source explicitly notes that while Adobe offers vastly superior technical capabilities for that pro-grade work needing granular control, Canva's feature set is often seen as good enough for a very large and growing segment of the market.
The ones who prioritize speed and simplicity.
Exactly. Speed, simplicity, collaboration over that deep technical control. Analysts like Citigroup are specifically cited raising concerns about Adobe potentially losing market share in the sort of down market or less technical segments of Creative Cloud to Canva.
And this competitive pressure from Canva is directly tied back to the market's muted reaction to the earnings.
It absolutely is, according to the source. The tepid stock response partly reflects this ongoing competitive pressure. The market is asking, can Adobe defend its turf, or will Canva keep chipping away, especially as Canva adds more features? Plus, as we discussed, there's that broader sentiment of AI fatigue. solid execution, clear AI adoption. It's not enough anymore. The market wants overwhelming, unambiguous financial proof that AI is driving transformative, accelerated growth quantitatively.
Mm,
And the source argues that hasn't fully materialized yet in a way that satisfies these sky-high expectations,
yeah.
despite the strong qualitative signs in management's confidence.
Yeah.
The sources even highlight a recent history of sharp stock declines after previous earnings, like nearly 14% after Q1, precisely because guidance, while solid, failed to meet these lofty AI-fueled hopes.
Are there internal risks Adobe faces too, according to the source? Things they need to manage themselves?
Yes. Adobe's main strategic answer to Canva in that more accessible market is their own simplified platform, Adobe Express.
Right. Express.
And while engagement on Express is strong, remember, AI usage tripled the source notes a long-term risk.
Mm.
As Express gets more powerful, more feature-rich,
Mm.
it could potentially cannibalize subscriptions from their higher-margin products, like Photoshop or Illustrator. For some users who decide Express is now good enough for what they need, it's a delicate balance.
Yeah, tricky.
The source also mentions, sort of, minor brand perception things related to bundled software, past security issues, but those aren't presented as major financial drivers compared to the competition or the AI monetization challenge.
Okay.
This whole competitive dynamic, it raises an important question for you listening to consider. The source suggests this isn't necessarily a simple zero-sum game, where one wins and the other dies.
Right.
Instead, it might be leading to a market bifurcation. Adobe is solidifying its grip on the high-end professional market. The photographers, designers, video editors who need that deep power.
Mm-hmm.
The risk is they might end up ceding the low-end, the quick and easy design segment, to Canva. The critical battleground, according to the source, is that huge, growing prosumer space.
The middle ground.
Exactly. Users needing more than basic templates, but less complexity than full Pro Tools. Adobe Express is positioned right there. The risk is, if Express fails to really capture that middle segment, it could potentially limit Adobe's future growth market.
That's a really interesting way to frame the competitive landscape. All right, let's shift gears. We've covered the strong performance, the big AI push, the competitive hurdles. Let's zoom out and look at how the market is actually valuing all this right now, because the sources highlight a really interesting paradox here about the stock itself.
It is a paradox, yeah. It basically means that depending on which traditional metric you look at, the stock can seem both pretty expensive and potentially undervalued all at the same time.
How so?
Well, on a trailing price-to-earnings basis, PE, looking at earnings over the last 12 months, the ratio is around 42.4x.
Okay, which sounds high.
It seems quite high, yeah. Suggests the market's paying a significant premium compared to many other companies. But, the source points out, that number is actually below Adobe's own 10-year historical average PE, which is closer to 49.15x.
Okay, so expensive maybe compared to the market, but cheaper than its own history? That's interesting.
Exactly. Now, what's really fascinating here is the PEG ratio, price earnings to growth.
Right, that factors in expected growth.
Precisely. It tries to account for future growth when looking at the PE. Adobe's PEG ratio is sitting around 0.59.
0.59, okay.
The source notes that a PEG ratio well below 1.0 is often seen as a strong signal that a stock might be undervalued relative to its expected earnings growth rate. It suggests the market isn't fully pricing in the company's anticipated future growth.
So expensive on trailing PE compared to some benchmarks, cheaper than its own history, and potentially cheap on a growth-adjusted basis using the PEG ratio. That really is a paradox. Where does that disconnect come from?
Exactly. This disconnect, this valuation paradox, it stems directly from the market's uncertainty about where future growth is going to come from, specifically the speed and scale of AI monetization.
Oh, back to AI again.
Always back to AI right now. Investors seem comfortable modeling the predictable, say, 10–12% growth they've seen from the core subscription business. That's known. But they were deeply uncertain if, how quickly, and by how much AI will layer an additional 5, 10, or maybe even more percentage points of exponential growth on top of that base.
Right.
So the low PEG ratio reflects that potential upside if the AI strategy really pays off. While the moderated PE relative to history reflects the market's risk aversion, it's skepticism that it might not deliver that kind of transformative, accelerated growth they're craving just yet.
How does Adobe's financial health and efficiency stack up against other tech giants? The source benchmarks it, right?
Yeah, it benchmarks Adobe against peers like Microsoft, Oracle, Salesforce, just to give some context. And while Adobe's PE ratio is generally in line with this group, Its profitability is described as best in class.
Okay.
Their trailing 12-month return on equity, ROE, it's around 47%. That's significantly higher than Microsoft, which is around 33%, or Salesforce around 10%.
Big difference.
Yeah, it's a powerful indicator of elite capital efficiency, how well they generate profit from the capital invested. And that 89% gross margin,
Incredible.
absolutely top of the software industry, reflects immense pricing power, super efficient operating model, plus they have a rock-solid balance sheet. Low debt-to-equity ratio, just 0.29. They aren't heavily leveraged.
So, strong fundamentals, best-in-class financial health, even compared to the giants, coupled with this valuation paradox. Given all this data, how is Wall Street generally viewing the stock right now? What's the analyst sentiment like?
Well, the analyst community, as you might expect given the paradox in these competing narratives, is clearly divided. The source lays out the landscape.
Okay.
You've got a bull camp firms like Jefferies, Morgan Stanley, with price targets up in the $500, $9,500 range.
Right.
Their thesis is basically that all this investor pessimism about AI competition has actually created a low bar for Adobe to clear, presenting a favorable risk-reward setup.
Interesting take.
They see the guidance raise after Q2 as a sign the core business is stronger than expected. And the price hike, plus early AI monetization, adds tailwinds the market isn't fully appreciating.
And on the more cautious side, who's in that camp?
Then you have the more cautious or neutral camp. Firms like Citigroup, UBS, with lower targets like $465 or $430.
Okay.
Their concerns are mainly centered on that Canva competition. Are they losing share down market? And whether the pace of AI monetization will be fast enough or large enough to really move the needle and offset any potential competitive losses.
So what's the overall consensus view if you average out all these different opinions?
The aggregate consensus, according to the source, is a moderate buy. The average price target is somewhere between, say, $503 and $519.
Okay, moderate pie.
But, and this is important, the source emphasizes the wide range of analyst price targets. They span all the way from $380 up to $645.
Wow, that's a huge range.
It is. And the source presents this wide dispersion as kind of a statistical proxy for the deep uncertainty specifically surrounding the financial impact of AI. Analyst models diverge almost entirely based on their different assumptions for how quickly and how large that AI-driven revenue stream will actually become. The disagreement isn't really about the health of the core business anymore. It's all about the magnitude and timing of the AI upside.
Okay, let's try and synthesize all this. The sources describe a company that's, well, executing flawlessly, demonstrating undeniable strength, rock-solid core subscription business, elite financials. But the market right now is singularly focused on the speed and scale of new, accelerated growth driven specifically by AI monetization.
Correct. The market is demanding proof, not just potential. When it comes to AI adding truly exponential growth to the top line, that paradox we started with, it's very clear by the end of the report.
Yeah.
Elite operational and financial performance is being met with investor indifference, maybe skepticism, because the quantitative AI revenue proof, while it's growing, is still considered nascent by the market, despite those strong qualitative signs of user adoption and management's confidence.
What catalysts could potentially change the market's mind? Unlock the value the source believes is there? What should investors be watching for as signs the AI story is really accelerating?
The source lists several key potential catalysts. One is if that AI ARR, the recurring revenue from AI, accelerates significantly faster than management's current projection of doubling by year-end.
Okay, faster growth.
That would be clear, quantitative proof of rapid monetization success. Another is if that 7% Creative Cloud price hike is absorbed with minimal subscriber churn.
Proving pricing power.
Exactly, confirming enduring pricing power even after layering in AI. A third catalyst would be if Adobe Express shows clear momentum, successfully gaining meaningful market share against Canva, especially in that crucial prosumer segment we talked about.
And conversely, what are the main risks that could derail this buy thesis presented in the source?
The primary risks highlighted are, 1, if AI monetization stalls or the uptake of those paid credits disappoints relative to projections. 2, if Canva continues to encroach significantly, not just at the low end, but on their core professional user base. And 3, if broad macroeconomic headwinds hit enterprise or consumer spending on software, which could mute growth across the board regardless of AI innovation.
Okay. Based on all this analysis from the source material, the strong core, the AI strategy, the competition, the valuation paradox, catalysts, risks, What's the overall recommendation the source arrives at?
The source concludes with a buy recommendation,
Mhm.
specifically positioning it for long-term investors, thinking out, say, 12 to 24 months.
And the core rationale for that long-term buy call, why buy despite the market's current mood?
The thesis is basically that the market is being myopic right now,
Hmm.
focusing too much on near-term AI revenue figures and fundamentally undervaluing the company's immense, durable profitability, its deeply entrenched market position built over decades, and its best-in-class financial profile. The source argues that low PEG ratio, we discussed, signals a favorable asymmetric risk-reward profile right now, meaning the strength and consistent cash flow of the core business provide a significant cushion on the downside,
Right, a safety net.
while the potential for successful AI monetization, though uncertain in scale and timing, offers significant, possibly unpriced upside, not yet reflected in the stock price.
And do they provide a specific price target based on that thesis?
Yes, they give a 12-month price target of $515.
July 15. Okay.
And this target comes from what they call a sum of the parts analysis, which basically values the core business conservatively based on its reliable fundamentals, and then adds a modest risk-adjusted value for that nascent but, promising AI opportunity.
And that aligns with.
It aligns with the more grounded views among the bull case analysts like Morgan Stanley we mentioned earlier.
Are there specific conditions that would make them reevaluate or maybe change this buy recommendation, warning signs?
Yes, the source is clear on this. The buy thesis would be reevaluated under specific negative conditions.
Such as.
Such as, if digital media ARR growth slows down into the single digits for 2 consecutive quarters, that would signal a fundamental weakening of the core. If management is forced to significantly lower its AI ARR growth targets, indicating a failure to monetize AI as expected. Or if there's concrete, sustained evidence of significant churn among their core professional users to competitors like Canva.
Okay, so there you have it, Adobe. A company hitting on all cylinders financially, demonstrating pristine execution, rock-solid core business, elite financials, but currently caught in this market tug-of-war. On one side, it's predictable, highly profitable, deeply entrenched core business. On the other, the market's seemingly insatiable demand for explosive AI-fueled growth, like right now.
Yeah, the deep dive into these sources really shows us a company with undeniable strengths, that sticky ecosystem, proven pricing power, robust financial discipline, clearly laying the groundwork for AI monetization.
Okay.
But at the same time, it faces real competitive threats, particularly from Canva in certain segments, and the significant challenge of meeting these incredibly high, maybe even unrealistic, market expectations for the pace and scale of AI's financial impact.
The paradox remains. Stellar execution versus market skepticism driven by that AI imperative. Based on everything we've just gone through from these sources, what really stands out to you?
Well, it raises an important question, I think, for you listening to consider. If the market is demanding this transformative, accelerated AI growth on top of Adobe's already strong base, how much AI revenue, and crucially, how quickly does it truly need to materialize to satisfy that demand? And to fully unlock the value the source believes is hidden in the company's durable core business.
A lot to think about for sure. We really appreciate you sharing these sources with us for this deep dive. It's been fascinating.
Absolutely. Good stuff to dig into.
Join us next time for another deep dive into the sources that matter to you.